following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Boot Camp, brought to you by Sogo Trade, an extraordinary value in online trading. Why pay more for the same trade when Sogo Trade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Now, let's get you into peak options trading shape. Here are your Options Boot Camp drill instructors, Mark Longo, Dan Passarelli, and John Critchley.
All right, everybody, welcome back to Options Boot Camp. This is, of course, the program here on Ye Old Options Insider Radio Network, where we take you, the basic options retail trader, and we break you down through a series of very difficult drills and some very elaborate beatings from our friend Mr. Passarelli. And then we rebuild you slowly and surely with some whispers of confidence from our friend Mr. Critchley into a seasoned and experienced options veteran. My name is Mark Longo from the OptionsInsider.com, as well as from the ever-expanding Options Insider Radio Network. And, of course, before we start off, I want to remind you that a lot of you have been writing in about our futures options program. When's it coming? When's it coming? It's coming soon. Hopefully, maybe even by the time you see this episode, it will be live on our network. But sometime in the next few weeks, you should have that great futures options program to enjoy for your very own in your podcast provider of choice, iTunes, Stitcher, Aha Mobile, our website, theoptionsinsider.com. Wherever you get your shows, it will be there for your listening pleasure. So stay tuned for that. And, of course, joining me on the old Options Bootcamp Drill Instructor Squad today, my two cohorts, my partners in crime, the collective yin to my yang. They are, of course, my fellow Bootcamp Drill Instructors, starting with the Mr. Black Hat himself. Some folks may even call him Mr. Prima Donna. He is none other than Dan Passarelli from MarketTakerMentoring.com. My fair lady, how do you this afternoon?
Well, hello, Mark, and glad to be here. We have got a great show planned for today, guys, so hang tight. Hang tight.
Yes, it should be a really good one today. It's going to be a lot of your feedback featured in today's show. And, of course, rounding out our panel today of bootcamp drill instructors, he is known as the Bulldog in certain circles for his harsh training instructing style. He is none other than John Critchley from SogoTrade.com. Mr. Critchley, welcome back to the show, sir.
Hi, Mark. Hi, Dan. Excited to be back. We have a sequel today, and I love sequels, so I'm real excited about the show today.
Yeah, you know, it's summer movie season, sequels everywhere. We thought, might as well do our own little sequel here, and pretty close on the heels of the other one, because as we expected, whenever we dive into that realm of calendar spreads, whenever you open that calendar spread Pandora's box, you never know what you're going to find, except a whole bunch of heartbreak and a whole bunch of confusion. And sure enough, a lot of you wrote in saying, well, how does this work? Well, how does that work? So we're going to get to all of that and much more on today's program, Calendar Spreads Part 2.
Mail call. Time to look at questions submitted by our listeners.
All right, listeners, welcome to this extended edition of the old mail call segment. This is, of course, a portion of the show where you, the listener, get your chance to sound off and chime in and make your voices heard on the old program. Before we dive in really quickly, I want to let you guys know on this program, a lot of you like to use Facebook to reach out to us, of course. There's been some confusion on our Facebook presence as of late because we had so many. We had the OptionsInsider.com, we had Options Insider Radio, we had kind of an Options Insider person page. Those are all vestigial remnants of our various Facebook endeavors at different times. We've since merged all them all now. So if you go to facebook.com/theoptionsinsider, that's pretty much our main Facebook presence now. You can find all of our posts, archive links to these shows, posts from our website, maybe some polls. You can interact with us. And of course, you can always post your questions there for this show. Or of course, you can do it at theoptionsinsider.com. Just surf on over, leave us a comment on maybe the show notes for this episode or on another article, wherever you want. Just make sure we know that it's coming for this show. And of course, you can always find us the old-fashioned way. Just shoot us an email, questions@theoptionsinsider.com. Like many of you did today, just be sure to put in the subject line the show you are referring to. All right, let's kick off this calendar spread palooza, a bonanza, if you will. Starting off with a question from Mr. Alpha Dog. He writes in, let's say I buy the Ford August week 1 17 call and then sell the July week 4 17 call for a 7-cent debit. So he's paying 7 cents for this simple horizontal time spread. How does that position make money? I don't get it. Don't both calls make/lose money as the stock goes up and down? This is a theme of many of the questions we received in regards to last week's episode. I should say last episode, because you do put out about twice a month. Of course, I encourage you, if you did miss the last episode, go back and check out our episode on time spreads and calendar spreads. It will set the stage for what we're going to talk about today. And this question is a common one. People don't understand those juxtaposing positions. In this case, he's talking about Ford. On the episode we did last time, I did my hypothetical XYZ July-August 50 call spread. He's doing a Ford 17 call spread. Very timely because we're recording this on the day of Ford earnings when Ford is trading right around 17. So I'm guessing this is a real position that perhaps this customer or this listener has on. So an interesting one. But you're right. That is the counterpoint to this argument. That is what really people are sitting down and scratching their heads over when they first are exposed to time spreads. I remember we walked you through a bunch of different examples, and we said essentially that if you're looking at these simple horizontals like this one is, on the last episode, remember we said that these are really designed for an underlying where you think it's probably not going to have a lot of movement. It's going to stay pretty range bound in the near term. In this example, he gives us this horizontal 17 call spread. Let's fast forward this now a week to July expiration. I know last episode we said, expiration graphs aren't ideal for explaining calendars, but they can be illustrative of certain points. And in this case, let's fast forward the rest of the week to July expiration now, or at least for this week 4 expiration. And we see that the stock hasn't moved. It's trading at 17 with this July call expiring. Now, of course, you can do the math at home, listeners. That July 17 call is going to go out worthless. And now you have just the remnants of this position, this Aug 17 call, that's going to be worth 0 plus some time premium. In this case, it's about a week. You got about a 7 cents. As long as it's 7 cents or more, you did all right on the spread. And that's an instant, easy way to think of it if the stock stays simply range bound, it doesn't move, and stays right where you want it to be. Now, of course, time spreads don't often work out that way. And Dan, I know when you're talking to your clients, a lot of the education that you do in the examples talks about what happens when the underlying starts to move and things actually start to happen in that time spread. And I think that's really what we need to do on this episode is walk our listeners through a full example of a simple horizontal time spread. I'll give you ladies' choice today. You can do this Aug 17 example in Ford. You can do my old XYZ example. You can make up your own, whatever you want. But let's walk our listeners through a nice point-by-point example of a simple 1-month calendar spread and how it looks at a couple of different underlying points. What say you, Senior Market Take You? Are you ready for this challenge, sir?
On the Ford trade, the listener was selling a shorter term option than he was buying, so therefore he's buying the time spread. He was selling the July week 4 17 calls and buying the August week 1 17 calls, so these trades are like a week apart. He was buying these for just a very, very small amount. He was paying a net of only 7 cents to put on this trade. So what's tricky with time spreads is most traders are used to looking at profit and loss diagrams. Well, profit and loss diagrams don't work at all when it comes to time spreads, or at least they don't work very well when it comes to time spreads. The only absolute risk information that you know is that the most you can lose is what you pay for the time spread. And specifically, we're talking at the time when that short option expires. If you hold on to it after that, well, I guess still the most you can lose is the 7 cents. So that's the maximum risk. Maximum profit potential, we don't really know for sure, because we don't know what the volatility of those August calls is going to be when the July calls expire. All we do know is that we can probably have a pretty good leveraged profit. Risking 7 cents, it's not uncommon in certain scenarios for traders to be able to, especially when the implied volatility is very high of the option they're selling, it's not uncommon for traders to be able to make 100%, 150% when it works out just right. So here's the gist of it. The stock needs to be right around 17 at these July options expiration. That's the whole premise of this. The stock needs to be right at 17 to have the maximum profit potential. It has to be somewhat close to 17 to have some sort of profit potential. If it moves far away from 17 in either direction, we got a loser. So that is basically how it works.
Yeah, and if it stays near term, you might make out. If it just gaps to, let's say, 18, you should still have enough of a differential to do all right and probably break even on the trade, maybe even make a little money. But once you start gapping out beyond, if it gaps to 20, maybe let's do that. Let's do that, Dan. Let's walk our listeners through a proverbial example of in this next week. Ford earnings are today after the close, I believe. Let's say Ford knocks the socks off of it and it gaps up to 20 before July expiration. What happens to our listener then?
Our listener's in trouble, and he's going to be listening even more intently on our shows in the future to learn never to make that mistake again. Basically, here's the trade would end up being a loser. He will lose his entire 7 cents if that happens. And here's how and here's why. You're long one call, you're short one call, so you would think when the stock rises, you make on one and you lose on the other, which is true. But you lose more on the short-term one than you do on the long-term one. You lose more on specifically the call that you're short than you make on the call that you're long. And that is because of what? Because of gamma, right? Remember when you read Trading Option Greeks years ago and you learned that options that have less time until expiration have higher gamma? And you also learn that when you sell options, you get negative gamma, in which movement is bad. And when you buy options, you get positive gamma, in which movement is good. So in this spread, we're selling that short-term option, so we're getting a lot of negative gamma, movement bad. And we're buying that long-term option, so we're getting a little bit of positive gamma, movement good. So when the stock moves up, that little tiny July 4th week option that you sold that was worth barely anything becomes worth a lot really fast because of gamma. And that's bad, of course, because you're short it. That August option that has a little bit more value and lower gamma, well, it becomes worth more, but it doesn't become worth as much more as you're losing on that shorter term call that you sold. Make sense?
Since we're hitting on the Gamma Vega trade-off, I'll jump to another question because it is a very, very timely one here from our friend Mr. Nevin Pierce, coming to us from sunny and warm, some may say scorching right now, Phoenix, Arizona. And he writes exactly this question. What is more important when trading time spreads? Gamma or Vega? Is Vega the source of profit and Gamma the source of risk, or vice versa? How do I profit on Vega without a corresponding large move that ends up costing me more with the Gamma? Please help options drill instructors. I'm in over my head. Great question, Mr. Nevin. And this, really this is the quintessential trade-off with time spreads. You will always have this delicate balance, this difficult dance between Gamma and Vega. That's just the nature of the beast. That's how these spreads work. And short answer to your long answer question really is that there is no one specific answer. There is no, Vega is the source of the profit, Gamma is the source of the risk, and vice versa, because it depends on the scenario. In reality, it really depends what your outlook is from these types of trades. If you're really expecting, some sort of differential in the volatility, then of course volatility is going to be your friend in that trade. You're going to want to load up on it or maybe short it depending on what you expect, and you're going to not want a lot of movement to offset those volatility profits. Vice versa, if you think the stock's going to move a lot and vol is probably going to stay the same, Gamma's going to be your friend and Vega was going to be your enemy, and you want to offset one versus the other. But that is the nature of the beast when it comes to time spreads, is Gamma versus Theta. So Gamma versus Vega. To say one is more important than the other, I would say probably for a lot of people listening to this show who are kind of getting into time spreads for the first time, they're probably going to start off with a simple, like our listener just wrote in, a simple 1 month or 1 week horizontal time spread. In those scenarios, most often you're going to be buying the long-term option, selling the near-term option. So I'd say for a lot of our listeners, Vega in the initial term, the initial trades, probably going to be more important from a profit perspective, and Gamma is going to be more of a risk focus. You want to mitigate your exposure to the negative Gamma because that, as Dan just outlined, is really the big source of your potential risk in these near-term time spreads. So when you're starting off, you're doing your basic weekly, let's say week 1 versus week 4, or even 1 month versus 1 week, or 3 months versus 1 month, you're going to have that long Vega versus short Gamma equation. So when you're putting those on, you want a underlying. That's why we say when you're talking about these long horizontal time spreads, and that's been a lot of our examples so far, that's why we always say you want these underlyings to stay put. You don't want them to move. In the Ford example, you want it to stay at the 17 strike. In my example from last episode, I wanted to stay XYZ at the 50 strike. You want these things not to move because you have that short Gamma in the front month, and that is your risk factor. So in these scenarios, I would say Gamma is the risk, Vega is the potential source of discrepancy, potential source of profit. But it does change. If you're shorting that equation kind of flips, and looking at what you're expecting that spread to do over the long term, that really will play into where your risk is and where your profit is. As for how do you profit on Vega without a corresponding large move that ends up costing me more with the Gamma? That's the nature of the beast. That's why we look at things like term structure. We look at how these months are priced from an implied volatility perspective. So before you put these trades on, you're hopefully you're finding a month in a series and a strike, and another month in another series and another strike that have some sort of disproportionate relationship from a volatility perspective, and you are attempting to capture it. You're looking at the term structure and saying, wow, this is an earnings month. I think it should be a lot higher from an implied vol perspective. I'm going to buy that month. In the meantime, I'm going to sell this nearer term month. I don't expect this underlying to really move that much in the 2 or 3 months intervening, so I'm going to short that, use that to finance my longer term buy. And because the underlying is not going to move that much, but because it's an earnings month that I'm buying, we're going to see an influx of implied volatility. So that discrepancy can move. That implied volatility differential can change and increase, and you can profit on that spread without a corresponding move in the underlying. But those are the types of scenarios you have to look for. They don't just fall in your lap. So that's why it is a difficult dance and a difficult challenge to trade time spreads effectively, because if you just slap them on willy-nilly on whatever underlying you like, you're right. It's going to be hard to find these scenarios where you get the Vega without the corresponding Gamma to come back and bite you. So it's a difficult dance, but one that if you put it on in a proper fashion, if you take your time, you do your screeners, you do your homework, you look at things like term structure, you understand how your names perform going into and coming out of earnings, and look back at a few earnings cycles and do some homework, you can usually have a reasonable chance of finding an opportunity here. All right, next question here from Mr. Tim Nettles. He writes, I'm confused about time spreads. Aren't you all? This is the moral of the story this week. He writes, I don't really get how they work and how I'm supposed to view them. For example, in the XYZ July-August 50 call example cited by Mark Longo that was in the previous episode, listeners, what do I do after the July leg expires? Should I even consider that, or should I close out the whole position prior to July expiration? What if I was using the short leg to finance a longer-term speculative play? Wouldn't it make sense then to leave the second leg on beyond the expiration of the first leg. And this gets into another reason why so many people are confused about time spreads, is how they view these entities. Is it two individual trades, or is it one unit? And in the last episode, I kind of urged you to look at them as a unit because it helps a little bit with understanding how these trades perform and how they work to your favor. But he makes a good point that if you're doing something very near term, like our listener wrote in with the forward weeklies, you're going to have to confront that expiration pretty quick. And so it becomes an interesting example of what are you doing? He makes a good case, and what for a lot of people use time spreads for, particularly long time spreads, is they buy a longer term option and then they use the shorter nearer term. Try that again. They buy a longer term option, they sell the nearer term option, perhaps a weekly, perhaps a monthly, and use that to finance the buying of the longer term option. A very popular example is, let's say, buying a monthly option and then writing each of the consecutive weekly options on that same strike, or maybe you move the strike around depending on where the underlying goes, in order to finance that long term play. So in that sense, if you're doing it that way, you're seeing it as a series of consecutive trades, and you're hoping those trades to expire worthless. You're probably going to buy them out before they close. We always encourage our listeners to not let your spreads or your trades really go out to expiration, but to close them out before them. But you're probably going to close them out right before expiration, then roll them to the next consecutive week or month, whatever you're looking to do in that particular case. But in that example, that's a really common use for time spreads. And if your underlying stays where it is, like we said in a lot of our examples, that's a great way to finance. Let's say you're buying this call for a month out, you're selling the weekly 17 call in forward, perhaps again against that. You're hoping forward stays put, forward stays put, forward stays put, all the way until that final week or month when that you finally get that other option, and you've been writing weeklies the whole way across the way, and you've been collecting all that time decay, exploiting that differential. We've talked about many times on the show in the past about nearer term options decaying much faster, having a much higher theta than longer term options, and exploiting that differential as a result. And so if you do it well, you can actually even collect a credit for that long-term option at the end of the day. But obviously, it's a delicate dance, a lot of adjustment that goes into that. But in a sense, if you're looking at it that way to finance a longer-term option buy, then yes, write that consecutive near-term option, let it expire, get close to expiration, close it out, roll it to the next week or the next month, and keep doing it. But yes, you definitely want to, if you're looking to keep that longer-term option and get it for a cheaper price, you want to keep rolling those nearer-term ones. Dan, let's say one of your clients comes to you and asks you this kind of question about time spreads. How do you typically view them? Are you more of a, well, it's a two separate legs and I manage them independently kind of thing, or you kind of view them as a unit and try to put them on, take them off as a unit? What's your approach here to time spreads?
Yes, that's exactly my approach.
All of the above.
It's somewhat situational, really. I like to, and we kind of talked about this in the last episode, with any kind of spread, 2 legs, 3 legs, 4 legs, whatever, I love to look at them in different ways. I like to look at them as a single spread unit, and I like to look at them on legs as individual trades. When you do that, when you kind of take this more holistic approach and look at it from all different angles, if you will, you get to understand that spread a lot better. Now, when it comes to having to roll, having to roll whether out of, hey, the trade's going my way, great, I'm going to roll out to the next month, or, holy cow, this trade's turned into a disaster, I've got to roll and come up with some sort of adjustment. Either way, I think it's really useful to kind of keep in mind what you had on when you first had the trade and kind of keep track, maybe even keep a spreadsheet to keep track of all the subsequent adjustments. For example, the one role that I teach is called the profit continuation strategy when it comes to time spreads. And that is when the trade happens to be working out just right. You know, maybe you buy the September 50 calls and sell the August 50 calls. Right at August expiration, the stock's sitting there right at 50. Perfect. Worked out great. You can roll out to another month. I mean, if there's weeklies, you can do that week after week after week. There's some planning required. The best way to plan that out is to give yourself a little bit of room to roll. So instead of having a time spread that's one expiration cycle apart, I like to sell a short-term expiration one, whether it's weeklies or monthlies, whatever, and then buy maybe a 6-month option, maybe even a longer-term option, because then when the stock does go your way and it is sitting pretty close to that short strike, I can roll out to another month while I just leave that long option on, but I'm rolling just the short option. So looking at it that way, I'm kind of looking at them as individual options, but I'm kind of looking at it in an even bigger picture too, where each individual option that I roll is still part of this one single strategy.
That's really the way you have to look at it is, it's a single strategy, but of course you have to manage the legs independently sometimes. But I think for people who are just wrapping their heads around it for the first time, that's probably the easiest way to look at it. And I like this use case for time spreads too for newer time spread users and traders. This idea, if you're having a hard time thinking about this, listeners, or wrapping your heads around it, think about it as a good way to finance a longer term position. So you're buying a longer term option, you're selling a nearer term one, and using some of that decay to offset the purchase. Let's say in that Ford example our listener wrote in on, he wants to have that. He really is looking for Ford to pop a week from now, but he wants to finance all that decay he's going to pay in the meantime, so he writes that nearer term one. Of course, there's earnings in between, so that complicates things a little bit. But in essence, that's a good way to think about it. If you're looking at longer term options, we talked about collars in the past and using those as a way to offset the price of maybe some of your protection. You can also look at time spreads in an analogous way to offset perhaps a longer term speculative position you want to put on. Maybe it's a call, maybe it's a put, whatever you want to do. These time spreads can be simple ways to help you do that. And because you're adjusting every week or every month, whatever it is, it allows you to adjust your strategy, at least that front leg, that nearer term leg, with what happens in the underlying. So if the underlying drops, maybe you're not writing the that 17 put anymore, maybe you're writing the 16 or vice versa, or maybe you're buying it depending on what you're doing in the spread. You can adjust with what happens in the underlying. So it's an interesting way to finance some longer term positions, and I encourage a lot of you to think of it that way because it's sometimes easier to wrap your heads around calendars from that perspective. All right, and Mr. John, I know you've been sitting patiently by, champing at the bit for your chance to dive in because, of course, like I said, we're recording this during the height of earnings season, earnings bonanza, and we just saw a Netflix report last night. And I know, John, you have a great example you want to walk our listeners through of a calendar in the old Widowmaker, a.k.a. Netflix. Take it away, sir.
Yeah, thanks, Mark. I'm an event junkie. I like the earnings season to play. I like the movement, and a lot of our customers call in and ask me about earnings plays, and I've written about them a lot in the past. And of course, we had, as we record this, we had the Netflix earnings, and as we mentioned in the last podcast, the typical behavior around earnings is a rise of volatility in anticipation of the event. That makes sense, followed by a quick drop after the earnings release. So the idea is the options become expensive before and they become cheap afterward. How do you play that? Well, what I do, and we've gone over this in the past, is I'll go back about maybe a year, 4 quarters. And for Netflix, for example, if you went back to last July, the stock moved 25% down after earnings. In October, it moved 11% up. This past January, it went up 41% post-earnings. This past April, 24% up. So, wow, that's about an average, about 25% move post-earnings. So when we looked at the volatility or the straddle, the front month, it was predicting about a 14% move. And that seemed like it was a discount. But if you look at the premium numbers, everybody, that was a lot. It was $36 in premium. So that was a lot. So to offset that, we say, well, let's look at how the 2-month or the back month volatility, how did that perform post-earnings? And we saw the volatility in the 2-month out options decrease 16 points, 13 points, 14 points, and 17 points, about 15-point average post-earnings for a 1 or 2 month out option. So when I looked at the position or the trade for Netflix, I was looking basically at the August 260 straddle versus the July 260 straddle calendar. And it was trading for about $6. And what happened? Well, the stock moved only 5.5%. So that was great for the sellers of July. But guess what happened? The August 260 straddle was trading at 72% implied volatility, which is very high. And it went all the way down to 44%. So it went down about almost 30 points. So that was bad for the owners of August, or if you own the calendar. So what ended up happening? It was a net wash. So the moral of the story kind of is that, well, first always do your homework, and if you have the numbers right, you may be right, you may be wrong, but see what happens in the past and see what happens really more importantly in the back month. If you buy a calendar, you say, wow, I can buy this calendar and look at the front month how high it is, but make sure you know that the back month is really going to get crushed post earnings. Now Netflix, the August went down almost 30 points in implied volatility. So even though you were right, wow, July didn't move. If you put the spread on, the August went down so much that the trade actually was a net wash. So that's a pretty good example for our customers or our listeners to listen. And as we record the show, we have Apple coming up tonight. And the Apple is implying about a 5% move or 4.7% move after earnings, which is about $20 in premium. And if you look over the last 4 quarters in Apple, very quickly I'll mention this, it was unchanged, down 12%, up 1%, down 4%. So about 5% is what the market makers are implying for the move. And so now we also do what, folks? We look at the back month volatility. It has gone down to 28, down to 32, down to 27, and down to 22%. And right now, guys, the 1 month volatility is trading about 27. So I tell my customers, or I say, I think using my experience, that after earnings, that volatility may go to maybe low 20 or even below 20 in August in Apple. And with the Vega about 40 cents, that'd be about $2.80 loss if you put the straddle on and nothing happened. So if I had to make a trade in Apple coming up, I would probably buy the August straddle, or probably buy the calendar, buy August and sell July, or just buy August, because I think the risk really there is $2 or $3. And if you get a big, huge move, then you can be a big winner. So my point is, do your homework, look at the past as an indicator of what will happen going forward.
Good advice, Mr. Critchley. And since you're on the timely tier, I think this next question is perfect for you. Next up, we have a question from Mr. Ron Yurovich, and he writes, on July 22nd, which was yesterday, I will buy one AUG 23 put, which is the monthly, for 32 cents, and sell one weekly, week 1, July 26 call for 16 cents. So he's getting roughly half of his price of his puts back here from that call. I plan to sell the following after the short side expires. So he's clearly planning for Facebook. This is, of course, in Facebook, in case I didn't mention this. He's planning for Facebook not to do much going into earnings, which are today after the close, I believe. And then he's going to, right after that short call expires, he's going to sell 2 of the AUG next week 23 puts, and then 9, interesting ratio, of the AUG 23 puts again, and then before he finally closes out his AUG 23 put position. What do you think about this plan on Facebook? I feel there will be a little weakness in the stock before it climbs any higher. Thanks, Ronald Yurovich. Well, Ronald, it's interesting trade you write in here. This kind of illustrates what we were talking about before, using the nearer term options to finance the longer term options. This one takes it a little bit further with some of the interesting ratios, 9 and then 2. It's interesting numbers. I'm not sure how you arrived at those ratios, but that may be getting a little bit aggressive in terms of the premium collecting. But then again, this is still using that same approach of hoping Facebook really doesn't go anywhere in the near term, and then trying to collect that theta, trying to collect that decay until Facebook pops. And then, of course, if Facebook does pop like you're planning, then this trade can actually work out, particularly if it takes a little while to get there and you get a chance to write those 23 puts for some decent premium before it finally pops. Mr. Critchley, what say you to our friend here writing in about Facebook?
Well, when I first looked at the question, I got a chance to peek at it before the show. I did a little double take. I had to decipher a little bit, but I think his plan is to first close the initial long puts after this Friday's expiration, which is after earnings, and then it looks like he's going on a selling spree by selling a whole bunch of Augie 13 23 puts. However, as you mentioned, Mark, there's earnings on the 24th or 23rd, so we really have to see where Facebook is post-earnings, because, as I just mentioned, remember, if I look back at Facebook post-earnings, the implied volatility, I have it down 11 points, 15, 11, if we go out 2 months. Right now, the implied volatility is about 57, so you could probably expect a mid-40s, low 40s implied volatility post-earnings. So, the August implied volatility is going to get crushed post-earnings, so I'm just not sure how much juice or how much premium will be left if Facebook goes a little bit higher or much higher post earnings, I just don't know how much premium this customer or this listener is going to get by selling them. And if he sells a lot of them for very low premium, he's putting on a lot of risk for not much bang. So I think it's really dependent upon how the earnings are, and then we maybe can reevaluate. But it's really a specific question that we don't really know the answer to. It's an unknown.
So you view this a little bit differently than I did. I assumed he was using that put selling spree, as you call it, to finance his longer term put. You think he's putting it on and then taking it off right after earnings and then commencing this downside selling spree in Facebook. That changes it up a little bit. Then I tend to agree with you. I'm not sure how wise or even viable that will be if Facebook does rally like it thinks it will. He says there'll be a little weakness. So if it does, it's trading 26 right now. If it gaps down to like 25 or 24 half, he might get a little bit bang for those 23 puts. But then if it starts to rally again, he won't. But yeah, I kind of viewed it as more of a chance to finance that longer term position and perhaps then hopefully even collect a credit on it.
Course. I mean, he seems like he's saying, I'm going to buy the 23, I'm going to buy the puts in August, sell July, and after the July expire, then I'm going to sell everything. But then the earnings are already going to be the cat's out of the bag already. So I just don't know how much premium he will have left. I'm not sure what Dan thinks about this, but that's how I read the question.
Yeah, I mean, I think that sounds about right. Yeah, I mean, I'm with you.
Are you on board with this 2-by-9 ratio? What he's doing here?
Yeah. Well, no. You know what? I mean, the deal is the ratio time spreads that's a recipe for a disaster, is what that is. Do them 1-to-1. If you want to start getting fancy, there's a lot of other fancy stuff that you can do that has way less risk and way less problems. Just because you can make more on a trade doesn't mean it's a better trade. Like I tell people, the easiest example is not a time spread at all, but a naked put versus a put spread. People say, well, if I sell a put spread, I don't make as much as I do if I sell a put. I say, oh, that's great. Well, sell 2 put spreads instead of 1 put. Then you make just as much and you have, lower risk. Here, doing a crazy ratio thing like this, you're just adding risk. More reward, sure, but that doesn't make a good trade. It's the risk reward ratio that makes for a good trade, and that, ladies and gentlemen, is not where it's at.
So Dan, you're not on board with my patented Longo 1/30 ratio calendar spread?
Well, I actually was going to patent the 1/31 ratio spread.
Curse you, Passarelli, foiled again. All right. And next up, we have a question from Mikos V. He writes, this is for you, John. He writes, for John Critchley on Options Bootcamp. Does Sogo have any plans to alter the way they handle the margin for short time spreads to avoid the issue you cited where they are margined the same as naked short positions? This seemed to waste a lot of capital and provide a disincentive to traders to take on these positions. Is there any way to provide better margin treatment, at least while the first leg of the trade is still active, or is that limited to portfolio margin clients only? And listeners, in case you missed the last episode, John walked us through an interesting example of if you're short the time spread. Now, we talked about buying this horizontal time spread a lot, but if you're short it, from a margin perspective, you don't get that much benefit as compared to just shorting the longer-term call outright, because from a margin perspective, the broker can't really assume that you're going to do something with that short leg after it expires and do something else to hedge. So it treats it as if you are a naked short that call, or whatever that longer-term option may be, and which, as you can imagine, is a little bit disconcerting for a lot of listeners who think they're getting some offsetting margin treatment. Now, John, I know you guys have been putting forth a lot of interesting margin tools over there at Sogo Trade. Any plans to be able to get something to address these concerns?
Unfortunately, I believe most, if not all, retail brokers, unless you have a portfolio margin, the example that this customer says is the case. There is a disincentive to short counter spreads. And the reason, let me explain, the reason is very simple. It's too tricky in a risk management sense for the retail brokers to handle. I wish I had my 3-year-old's magic wand and I could wave it and create a fair way, but that just isn't the case. If we wanted to provide fair margin, we would have to run some kind of risk scan putting the date 1 day ahead of expiration and see which accounts would then have naked positions that they couldn't handle. Then we would have to notify our clients to please take action before the front month expires. Our clearing firm has the same logic in place. So does E-Trade, Scottrade, et cetera. Now, again, if you have portfolio margining, that isn't the case. But, the mechanics are just too tricky for the most retail brokers, too complicated, too time-consuming. So I think that unless you have portfolio margining, that is unfortunately going to be the case.
Now, it is a shame. We talk a lot about incentivizing retail traders to get into options more, and the show is clearly aimed at doing that. You guys at Sogo really obviously have a vested interest in doing that because you're doing the show, and it's not clearly aimed at you because it's not, it's nothing you guys can do about it. It's more industry wide. It just is a shame in general that we lock so many of the benefits of really the right way of trading behind that portfolio margin wall, that $100,000 account limit, because that cuts off so many great benefits for a lot of people listening to a show like this who may have $25,000 in their trading account and they want to start trading right and they want to start doing calendars as opposed to just buying a ton out of money calls. And because of the way the industry is set up right now, they just don't get the benefits of doing that. It's really a shame. But unfortunately, guys like you at Sogo, you don't make the rules. You just got to live by them. And until that starts changing across the board, people have to live with that, unfortunately.
And most traders, as when Dan and Mark were traders, we constantly had positions on like this customer's explaining, and because of portfolio margining or the very complex risk parameters of Bear Stearns or whoever was doing the risk, we could do this. But the retail customer, it's a little trickier and much more capital intensive margin wise.
Next up, we have a question from Emily Duncan, the ladies writing in, representing on today's show, writing in from Fairfax, Virginia. She writes, so let me see if I have this straight. If I buy the Facebook AUG 26 call for $1.25 and I sell the July week 4 26 call for $1.05, I've net paid 20-cent debit for a 1-month calendar spread. So far, so good, Emily. You have that straight. She goes on to write, if Facebook rallies to 28 by expiration this week, I will have lost roughly $1 on my July calls and made about 80 cents on my August calls. So I pretty much would have broken even, or am I completely off base with my understanding of how this spread works? So she's walking us through a scenario here, Dan, where she puts on this 1-month horizontal spread for a little bit of a net debit. And kind of like what we talked about earlier in the show, what happens if the stock gaps up through earnings here this week?
I see where you're going with this, Emily, but I'm not really sure where you're getting these numbers from. So how do you know that if the stock rallies up to 28, that you're going to make 80 cents on one and lose $1 on the other? How do you know that? Are you looking at delta and gamma and theta and estimating that? Are you modeling it somehow? Are you just kind of guessing? Because I don't know that those numbers have any validity. Maybe that's right. Maybe you modeled it and that's what the pricing model told you. And if that's the case, and it could be the case, it doesn't look like it's necessarily that far-fetched or anything like that. If that is the case and those numbers are predicted to be accurate, they're just an estimate, keep in mind, but if they're predicted to be accurate, then yeah, that's exactly it. If the stock rallies, you're going to lose a lot on the short call, you're going to make a little bit on the long call because of that gamma discussion that we had earlier. So there is a break-even point, and I don't know if $28 a share is exactly the break-even point or not, but there's a break-even point to the upside, and if you move above it, you're a loser, and if you stay below it, you're a winner.
Emily and all of the others out there, if you're still having trouble really wrapping your heads around how these trades perform in the various stages of underlying and the various Greeks, your brokerage firm, Sogo, of course, has this, and other firms out there have something similar. They'll have some sort of trade calculator out there on their site, and you can plug in these different legs and do a little bit of homework. You can adjust the underlying to see how this trade performs. in this scenario with Facebook gapping up to 28 and maybe you can roll it through expiration, see how it looks. You can roll it back before expiration. You can drop the underlying down. You can do a lot of cool things, and I know Sogo has that, so I encourage you to surf on over to sogotrade.com if you're a client, to go in, log in, play around with that trade calculator, because for all the talking we do about expiration graphs being difficult to understand and use for these things, at the very least, these types of things can show you how these dynamic trades adjust to different market environments. And as you see that, it might give you a better handle for how these trades perform. Because like Dan, these numbers sound all right, but I don't know if they're correct. I haven't sat down and done the math and rolled the numbers myself to see if you are going to break even on that or not. But it sounds about right. It sounds about if the thing gaps up $2. Just remember what we talked about earlier. We talked about long time spread, long horizontal time spread, I should say. Your long Vega, short Gamma. If it gaps up in the near term before that near term leg expires, that short Gamma is going to kick in. And eventually, at some point, whether it's 28, whether it's a little lower, whether it's a little higher, you're going to start losing money. So that's why we say when you're doing these simple 1 month or 1 week, whatever the case may be, horizontal time spreads, and you're buying them, you really want that underlying to stay put. So great question here, Emily. John, you have anything to add here? You want to walk Emily through any tools you may have on Sogo that would be relevant for her learning more about this?
Yes, I mean, she brings up a great point. And if you go to our tools section, I think I mentioned this in the last episode, we have an option calculator. She could put in $28. She could look, and it would give you the theoretical price of the August and the July calls. But the tricky part about that is that, and Dan hit on it, 100% correct, is you don't know where the implied volatility is going to go. Now it looks to me like with the Julys are going to be $2. They're going to be parity. And now the real question is how much premium is going to be in the August? How much, because now the August calls are going to be $2 in the money. So the corresponding puts probably wouldn't have too much value. So there probably wouldn't be too much premium or extrinsic value in the Augies. So it probably would be a break even. I mean, I don't think she would really lose too much. I mean, Facebook is still a pretty volatile stock, and probably should be some premium there, but it's kind of guesswork, and you have to go back again, do your research and look how volatility has behaved, post earnings. And if you do that, you can get a pretty good indication of what may happen.
All right, and rounding out this calendar spread listener mail palooza, we have a question from Mr. Tim Anders. And he writes, so if I have no bias and expect no movement, I should buy a time spread to profit from decay in the front month. Why not just short front month instead and save the hassle? Interesting question, Tim. And this gets into the heart of what we were talking about earlier. Some of your reasons and motivations for doing these simple horizontal time spreads. And you're right, you are attempting to profit from the time decay, but that's not the only factor at work here. There's a lot of different reasons you may want to do a horizontal time spread. Remember, we talked earlier, you have a longer term position and you want to finance it with the shorter term positions. In that sense, you're not looking to profit from the time decay as much as you are looking to profit on this longer term position, and you want to finance the carry until that position could kick in for you. So in that case, maybe you have a 3-month out call, you're buying in XYZ, and you're financing by selling the 1 month or maybe even the weekly XYZ call, and you keep rolling that at whatever level to keep offsetting the premium you paid until at some point maybe XYZ starts to run, and you can take off that short leg and let that long leg work for you the way you intended. So in that case, you're not looking to really profit from the time decay as much as you are looking for that to offset what you paid. The time decay really isn't the whole factor. That's what I'm trying to say. You're going to have a differential, and that's a good thing, and you're hoping that decay will increase in the front month. You can take advantage of it so that you can take advantage of that differential, and that spread will widen. But at the end of the day, what you want is for that spread to widen, and that could happen in a number of different ways. It could be time decay, but it could also be some underlying movement. It could be an increase in Vega in the longer term month versus a decrease in the shorter term month. There's a lot of different ways for that to happen. Time decay is just one of them. So if you're just out there naked blasting out front month options or near term options, whatever the case may be, not exactly the same thing as buying a time spread, neither from a risk perspective or from a margin perspective or from a number of other reasons, where time spreads are probably a little bit more advantageous in those scenarios than just naked blasting out a bunch of near-term options. Mr. P, what say you to our friend here, Mr. Tim Anders, who wants to just start blasting front month?
Yeah, it's all about risk management, baby. I mean, your question is like saying, well, if I'm playing, if you're playing darts, why don't you just always hit the bullseye? Why do you throw it at the board and not hit the bullseye? You should just always aim for the bullseye and hit it every time.
Is that not how you play darts? That's how I play darts.
Well, it's great. Aim for it, but you're not going to hit it every time. So sometimes you're going to miss. Sometimes you're going to get it like way on the end of the board. Sometimes you're going to get it off the board. Every once in a while, somebody's going to drink too much and trip into you while you're throwing the dart, and you're going to knock somebody's eye out. Like crazy things happen. You start selling naked options because you just want to collect the time decay, and they call that the time bomb strategy. One of these days, crazy is going to happen, and you're going to be the beneficiary of very, very bad timing, and you're going to lose your entire account. And this is a smarter way to do it. Limited risk.
Dan, clearly you never played darts with me, sir. You don't know my bullseye-only strategy.
I would be the drunk guy who falls into you while you're shooting.
Ah, yes. Thereby setting off my carefully planned bullseye-only and also 1/30 patent-pending calendar ratio spread strategy. Lots of winning strategies I have here up my sleeve for a variety of scenarios.
I just want to mention one thing that we've noticed in the last maybe few months, that the clearing firms are really tightening up or raising the margin requirements. For example, we had Tesla getting marked at 75% requirement for naked positions. So for Mr. Anders here, a time spread might be the way to go here, because the naked positions carry such a high requirement. I think unreasonable, but very high requirements, especially in a high-flying stock, that you need a lot of money to be able to do that. Plus, Dan's 100% right. You're going to be right 9 times. The 10th time that you're wrong, you're going to see an 8% move in the stock, and then you're going to be out of business, lose all your money. So that's the reason why, time spreads are a risk, reducer or a risk mitigator.
All right. Thank you for that question, Mr. Tim. And, of course, thank you to all of you who wrote in. A lot of great questions today. And I kind of expected this to happen whenever you open, like I said, that calendar spread Pandora's box. A lot of great stuff comes flying out. And so we love to have you guys write in. If you want to follow suit with your fellow listeners, like I said, you can find us on Facebook, facebook.com/TheOptionsInsider. Find us on Twitter, twitter.com/options. Or, of course, just go to the mothership, theoptionsinsider.com. Leave us a comment. Shoot us an email, questions@theoptionsinsider.com. A lot of great ways to get your voice heard here on the old mail call segment. But unfortunately, that's all the time we have for this episode of Options Boot Camp. Before we go, let me check in with each of my cohorts, my partners in crime, to see what they have cooking that may interest you, the listener. Starting off with you, John. Give us a tease, an update on what's going on with all the latest margin tools over there at SoGoTrade.com.
Yeah, we're just tweaking the margin requirements, and we're trying to really keep on top of the ever-rising requirements for these high-flying stocks. The one thing I want to mention also, just so customers know, at Sogo Trade, we're talking about spreads now. For these spreads, we only charge one ticket charge. Some other firms do, some don't, but we just charge the one $5 ticket charge. And if you do 4 legs, it's just the number of contracts. So it's not separate ticket charges. So we try to make it, as we have this new margin available, we're trying to encourage spread trading. So we're trying to limit the ticket charges. So, we're hopeful that this comes out, does well, and we'll see.
Margin, like I said before, really is the unsung portion of the education component, of the trading component, of the brokerage component. The brokerage firm that can really make this stuff much more transparent to the end user, make it easier for them to understand what's going on with their account, how their margin is calculated, and to use that much more effectively in their trading, I think is going to win at the end of the day. Because it's still at a lot of brokerage firms, you jump up there and they'll say, here's your stock buying power, here's your option buying power, here's this, here's how this will impact your buying power. It still is very opaque to a lot of people. How do they calculate this? You have to click in and do a lot of crazy things. And even then, sometimes it's not clear, why is my option buying power this? Why is this trade impacting me this way? So if Sogo Trade is the one to really bring that to the fore, that would be great, because, there still is so much work that needs to be done in making that transparent to the end user of exactly how this margin impacts them. Because as we've said on the show many times, and we're seeing it with more names now, you mentioned Tesla. People were writing in to us at Insider last week about BlackBerry. That's just a $9 stock, but a lot of that stock's gapped down quite a bit over the past few weeks. A lot of brokerage firms have gapped up their margin requirements on that as well. So there's increased margin across the board. And if you're not aware of that and how that impacts your trading, it's really going to cost you at the end of the day. So I'm glad to hear that you guys, Sogo, are leading the charge in really making margin transparent to the end user. All right, and last but certainly not least, we have the fancy lady over there at MarketTaker.com. Mr. Dan, what is cooking in the land of the Market Taker?
Well, as you guys know, in the past, I threatened for months to launch a new class, which of course is our Futures Options class. And when you listen to the Options Insider Radio Network's new show, which is on futures options, you're going to hear our newest coach in our roster, Dave Rogers, who will be featured on one or two of those shows, I think.
Both of them so far. We have 2 in the can that are undergoing post-production as we speak, and he is on both of them.
So you get a little flavor for what that Futures Options class is all about.
And listeners, like I said before, I hate to keep plugging it, but stay tuned for that. These are just some epic panels. They're huge. You got so many people really weighing in on the futures options realm and the market and the landscape. It's probably some of the biggest panels we've done for one of our shows, aside from maybe a big live event show. So they're really fun, really exciting. We're looking forward to doing more of them. Like I said, we have the first 2 episodes in the can. They're coming to an audio provider of your choice near you very soon, so stay tuned for that. And on behalf of John and Dan and, of course, myself, I want to thank all of you out there in the listening audience for downloading and streaming and writing in and making this such a fun show to do episode after episode. And we'll see you next time right here on Options Bootcamp.
Options Bootcamp is brought to you by Sogo Trade, an extraordinary value in online trading. Why pay more for the same trade when Sogo Trade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Options Bootcamp is produced by the Options Insider, Inc. All rights reserved.
The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.